In the desert city of Reno, Nevada, a faint hum cuts through the silence of the night. While the rest of the desert sleeps under the cold, starlit sky, one factory remains alive, its metallic glow pulsing like a heartbeat in the dark. That glow belongs to Dragonfly Energy Holdings, a company once hailed as the beacon of America's clean energy future. But as investors have since discovered, beneath its shimmering surface lies a far more complicated and deeply puzzling story. Dragonfly Energy manufactures lithium iron phosphate batteries and energy storage systems, technologies that store electricity for later use. Its products power recreational vehicles, marine vessels, and off-grid environments disconnected from traditional power grids. At first glance, the company fits neatly into the narrative of the clean tech revolution, a pioneer in sustainable power, advancing innovative dry electrode processes that promise cheaper, greener, and more efficient batteries. But a closer look at its financials tells a very different story, one where ambition outpaces results and optimism clashes with the unforgiving arithmetic of the market. Before diving deeper into that story, if you're watching this as a YouTube short, click the full version link below to continue listening without interruption. The year was 2022. In May, Dragonfly announced plans to merge with a special purpose acquisition company, or SPAC, known as CNTQ. SPACs are shell entities designed to take private firms public without the lengthy and complex traditional IPO process. At the time, Dragonfly was valued at roughly $500 million, a striking number for a company still in its developmental phase. By October of that year, the merger was complete, and Dragonfly made its debut on the NASDAQ under the ticker symbol DFLI. Investors saw it as a victory for innovation, a moment when American battery technology could rival the Asian giants dominating the sector. But just 2 years later, that optimism began to crumble. By 2024, Dragonfly's annual revenue had fallen to around $50 million, a 20% drop from the previous year. Gross profit came in at roughly $11 million, while operating losses widened to $25 million, and net losses ballooned to more than $40 million. Typically, as tech firms grow, their losses narrow. Scaling production lowers costs and boosts efficiency. Dragonfly, however, defied this trend. Revenue shrank, losses deepened, and the company's cash reserves eroded faster than expected. It was as if the business had entered a loop where innovation absorbed money faster than it could generate it. In July 2024, a glimmer of hope appeared. Dragonfly announced a brand licensing agreement with Stryten Energy, a major North American battery manufacturer. The deal granted Stryten the right to use Dragonfly's Battle-Born Batteries brand, with royalties projected to reach as high as $30 million. The press coverage was glowing. Analysts called it a validation of Dragonfly's brand power. Investors cheered, anticipating a new source of recurring revenue that could stabilize the balance sheet. But when the company released its subsequent financial statements, reality hit hard. The revenue actually recognized from the agreement was only about $4 million, a mere fraction of the promised sum. Normally, such brand licensing deals include a lump sum payment up front, followed by periodic royalty income as product sales ramp up. In Dragonfly's case, there was no follow-through, no steady flow of royalties, no sign of expanded market traction. The deal, which had once been heralded as transformative, now looked symbolic at best. It raised uncomfortable questions. Had the contract stalled? Had Stryten failed to achieve the expected sales? Or had Dragonfly overpromised to the market? Whatever the explanation, the result was undeniable. Cash flow did not follow the press release. For investors, it was the first major red flag, a mystery of optimism without substance. Then came November 2024. In a move rarely seen outside distressed microcaps, Dragonfly executed a 1-for-9 reverse stock split. Reverse splits are often a last resort to artificially inflate share prices and avoid delisting. They rarely reflect improving fundamentals. And yet, less than a year later, in October 2025, Dragonfly's shareholders approved authorization for another potential reverse split. Under normal circumstances, companies take months, sometimes years, to rebuild stability after such a measure. Dragonfly's quick reauthorization suggested something different. The company was preparing for further dilution, perhaps another capital raise, to stay afloat. And that is exactly what happened. That same month, Dragonfly completed two large public offerings. The first issued roughly 20 million shares at $1.5 each. The second followed soon after, 36 million shares priced at about $1.35. Combined, they raised approximately $55 million. This was not venture capital, it wasn't a strategic partnership. It was dilution directly from the market, tapping retail investors for liquidity. For a supposed technology innovator, this strategy was highly unusual. Typically, advanced battery firms secure funding through institutional investors, government programs, or industry alliances. Dragonfly's repeated reliance on public offerings signaled distress. It was a company funding its operations not with growth, but with survival tactics. Then, on October 21st, 2025, a familiar headline emerged: Dragonfly Energy regains NASDAQ compliance. The company had narrowly avoided delisting after its stock price fell below the minimum threshold. On paper, this was good news. In practice, it revealed something darker. The recovery was not driven by technology breakthroughs or operational improvements, but by mechanical financial maneuvers, reverse splits, and capital injections. Dragonfly was alive, but only because the market allowed it to be. Investors began to whisper, was this still a technology company, or had it become a financial construct engineered for endurance rather than innovation? CEO Dennis Fares continued to exude confidence. Our dry electrode technology will revolutionize the battery industry, he declared. The technology itself, producing electrodes without liquid solvents, does have potential. It reduces costs, limits pollution, and could pave the way for solid-state batteries. But potential alone doesn't pay salaries or rent factory space. Commercialization requires pilot production, mass manufacturing, and actual customer demand. Most battery startups, once they cross the commercialization threshold, begin to scale revenue. Dragonfly, however, remains trapped in a cycle of R&D and recurring losses. Either the technology isn't ready or the costs of scaling it are simply too high. In either case, the gap between promise and performance continues to widen. And so, the mystery persists. How can a company with falling revenue, mounting losses, and relentless dilution continue to survive? What keeps its factory lights on in the Nevada desert? Is it technology or hope? Is it progress or the inertia of capital unwilling to let go? Dragonfly Energy Holdings stands as both a symbol and a warning. In the modern markets, survival can sometimes masquerade as success. And now, Valuester would like to hear from you. Which publicly traded, private, or soon-to-be listed stocks, or even cryptocurrencies are you most curious about? Share your thoughts in the comments below. Your insight might shape our next investigation. Finally, to everyone who watches, subscribes, likes, comments, and shares our videos, thank you. Your engagement and curiosity drive this channel forward. We promise to continue delivering deeper, sharper, and more revealing stories about the world's most fascinating companies. This was Valuester.